half an hour away from the Opens in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne Man with Annabelle Jewelers.
Our top stories. The dollar falls against peers. That's after reports that President Trump may name a replacement for Fed Chair Jay Powell early, signaling rate cuts may come sooner than expected.
Hong Kong's de facto central bank intervenes in markets to prop up the Hong Kong dollar for the first time in 2 years, defending the peg to the greenback.
And a Bloomberg exclusive. We hear from CATL's chief manufacturing officer discussing competition in China and the company's global expansion plans. Taking a look at the market action today, and really if there's one big story that's playing out in the sentiment so far, it is actually reporting we had from the Wall Street Journal. So we're going to get into all the details in just a moment, but to suffice to say at this stage, the headline is that President Trump may bring forward the date to name a new Fed chair. Now we can get into all the implications of why that matters in a moment, bringing the date forward. But at this point in time, we're also taking a look at the Bloomberg US dollar gauge, because you can see that softness and as well a bit of a pullback in Treasury yields, particularly at the front end of the curve, more rate sensitive, of course, and the expectation from this story as well, the interpretation is that we could see rate cuts earlier. I mean, the pricing right now we're seeing for September, maybe the odds are rising for July, 25 basis point reduction as well. So that's playing across the market dynamic today. You can see here equities, the broader gauge moving 0.4% to the upside. The dollar story is also playing out in other ways as well. But let's take a look at what's happening pre-market ahead of the session in China today, watching the Hong Kong dollar really closely, actually, because there's some more details that have dropped earlier today. The big news is that the de facto central bank here, that's the HKMA, of course, has stepped in once again to defend the peg. Now, that's permitted 775 to 785. It's a range that's been in place for a couple of decades now. But the last time we saw intervention of this scale was back in May of 2023. Again, we'll get into the details of that in just a moment. Switching on, taking a look at quickly what's happening in the semiconductor space today, because overnight, we had Nvidia rising more than 4%, hitting a fresh record actually for the stock, but we're up more than 60% actually since the low in April of this year. In terms of the catalyst for that, you're talking about the recent earnings report that was positive despite the restrictions on sales to China, and still they're seeing strong demand. But again, it's really that story around, well, the Wall Street Journal, but what they're saying about President Trump today with the Fed.
Yeah, how they're expressing it is with the dollar, as you say, right? The Bloomberg dollar index now falling to the lowest we've seen since April 2022. So we are at those 3-year lows now for the greenback. And, you know, really, in the flip side of things, it's the euro, which is the power play here right now, that we really have to talk about when it comes to the G10 space and how that's going to lead to more of a bid when it comes to Asia FX. But you mentioned it is about this journal sort of report. Before that, though, we did hear from Jay Powell at, of course, another day of testimony, and really talking about how tariffs, you know, they're not quite sure just yet what it means for inflation. Let's take a listen.
The question is, who's going to pay for the tariffs? Originally, it's the importer, but it gets passed along through the distribution chain to some extent to the consumer. The ultimate question of it is how much of it does show up in inflation. And honestly, it's very hard to predict that in advance.
There's still a question mark on that, but then again, a lot of people that we talked to, some guests have said, if it wasn't for the whole tariff threat, the Fed probably would have been cutting already in the summer. So underneath all of that, there is still this market and this narrative right now that maybe it's more July than September.
Yeah, and I mean, something that's really put a bit of fuel on the fire this morning, of course, is that reporting from the Wall Street Journal, because, I mean, it's not just about bringing the date forward, it's also about who is picked as well. And there's a couple of different names. I mean, Bloomberg's already had reporting on some of those, but just to draw some of them out, there's the former Fed Governor, Kevin Warsh, there's the National Economic Council Director, Kevin Hassett, Scott Besson is one that's been pitched as well. Again, this is all according to their sources, but it really is that big question of, do we see rate cuts earlier, and what's sort of the mandate that, or the reason for giving someone an earlier pick or nomination as well? But President Trump's spoken about this. Let's just listen to what he had to say.
Yeah, I know within 3 or 4 people who are going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible. We have no inflation. We have a tremendous economy.
Let's bring in our MI strategist, Mark Cranfield. He joins us now from Singapore. I mean, the market is just going ahead with it right now. Market seems, whether we get a new Fed chair early or not, whether we see more dovish Fed early or not, how are we overreacting in some ways right now?
I think what you're getting here is that the investors are basically, they're coming to a conclusion that if Donald Trump goes ahead with the ideas which are being suggested of announcing a nominee earlier than usual, and that whoever he nominates, whichever of the candidates, are presumably somebody that he's already discussed. It's very clear to the markets that Donald Trump wants lower interest rates. So there will be a big assumption among traders and investors that whoever he appoints is somebody who's already told him that, yes, I agree with that view, and we'll get on with lowering interest rates as soon as possible. So the minute the markets have an idea that a new person is coming in, they will assume that the lower interest rates will be coming fairly quickly thereafter. Indeed, if the announcement comes very early, you almost get in a situation where people will think Jerome Powell has become a lame duck Fed chairman, and that you only should be listening to comments from the person who's coming in, or from people currently in the Federal Reserve who already agree with the view that interest rates should be coming down. And we've seen that recently with people such as Mr. Waller, who clearly suggest that July is a very realistic possibility for a rate cut. Now, the rest of the Fed have to agree with him on that. But you can be reasonably assured that in the coming weeks, the Fed speakers will be getting on board with that message, that they will be reinforcing the idea that inflation is not much of a concern and that interest rates have room to come down. In a way, you could say they've taken a pause, as you were indicating earlier. If it hadn't been for the fact that tariffs came along, the Fed would have probably lowered interest rates by now anyway. They started to do so last year. It looked as though there would be some cuts, or at least one in the beginning of this year. That hasn't happened. So you could well say that the Fed is behind the curve only because tariffs were introduced in between. So really, that's going to up the pressure for July quite a lot. We're pricing for September as a rate cut already. It wouldn't take much for financial markets to move that forward to the July. By the time we get to the meeting, it's right at the end of the month anyway, so there's plenty of time for traders to price it in and say 25 on the table. The Fed just has to walk through an open door.
And we're seeing it being expressed, as we talked about, in the dollar, in the euro. You've been writing a lot about this, Mark, about this power play that we're seeing in the euro right now. The sights seem to be, we're looking at 120 now for the currency. Is this really going to be the inflection point for the euro?
The thing about currencies is there's always a two-sided point to the currency markets. It's all very well to say we see weakness for the US dollar. The story is becoming a bit negative for the US dollar. But you need a positive story on the other side. And that's where the euro comes in. And of course, the fact that it's the second largest currency in the global market is very significant. So you're getting negative factors falling for the US dollar, the fact that interest rates may come down, the fact that the trade deficit could widen, fiscal situation is not so good. But the positives are now stacking up. You have a NATO meeting going on this week. It looks as though Europe have agreed there needs to be much bigger defense spending. That's a positive for the euro as well. Money starting to move into European equities as well. So that is really like a juggernaut movement, because the euro can attract a huge amount of fund flows, and it's beginning to be seen. During yesterday's global trading euro options were 4 times as big as yen options. You very rarely see that happen, apart from when people are shifting a huge amount of money into the shared currency. We have a Bloomberg story suggesting that 117 is a very significant mark because there's a lot of option strikes expiring there. If we push through 117, we're not too far away from people thinking that 120 will be the next step.
And Mark, closer to home, of course, there's what's happening with the Hong Kong dollar and the peg being needed to be defended once again. But what are you making of what we're seeing here?
The most interesting thing that we need to watch for in the next few days and weeks is whether or not those short-term Hong Kong dollar rates move away from Chinese rates. This is something we've probably never seen it before, but what's happened over the past few weeks, is that as the Hong Kong dollar weakened, rather than short-term Hong Kong dollar rates converging upwards to US rates, they've gone down to meet Chinese interest rates. That's a very unusual occurrence. If that's because the Hong Kong economy obviously needs lower interest rates, and the Federal Reserve is not yet providing that for them. So if the Hong Kong market is going to shift more towards following what happens in China, that means that the Hong Kong dollar will stay weak for a very extended period of time. That's not necessarily a bad thing. The mechanism is in place. The Hong Kong Monetary Authority have already shown they can handle it with no concerns. They've intervened again this time. Ironically, it was only a few weeks ago that they were selling Hong Kong dollars to weaken it. Now they're able to buy some to keep the peg in place. So that's not really an issue. Much more interesting is whether or not we see this convergence last for longer, where short-term rates stay low in relation to Chinese rates rather than US rates. That could well be telling us that in the very long term, investors are thinking that eventually, if the Hong Kong dollar ever needs to be replaced, the yuan would be the natural replacement for it.
Yeah, and actually, to your point there, Mark, around intervention, our Bloomberg intelligence team is pointing out this morning that this is the first time that we've seen the HKMA intervening in both ends of that allowable range going back to May 2005. But that was our Bloomberg MLive strategist, Mark Cranfield, there. And we'll have more, of course, on the HKD coming up. But OCBC is going to be joining us, OCBC Bank, to discuss the intervention to shore up the currency and defend, as we said, that dollar peg that's been in place. But counting down to the open of trade in Shanghai, Shenzhen, Hong Kong. You're watching The China Show. You're watching The China Show, taking a look at how futures are faring. We are just about 15 minutes from the open of cash markets this morning, and we're guiding actually, I would say, very muted start to the day. So not really catching the bid that we're seeing across broader Asian equities. But, I mean, Yvonne, it's been a really good rally so far.
Yeah, it has been, and maybe it's time to take a bit of a breather. But a lot of the movement that we've seen in the last 24 hours has been in the FX markets, particularly when it comes to the Hong Kong dollar, and HKMA stepping in as well. Take a look at the superlatives in this stocks rally, though. It really has been a Hong Kong story of late, right? When you have the HSI and H shares the highest since March, but you're starting to see maybe a little bit more of that onshore action, right? CSI 300 now getting back to similar sort of peaks there, or I should say, or at least topping the 2025 peak for the Shanghai Composite. And what's been driving that? Obviously, the growth stocks, tech certainly has been one thing, but the financials in particular, like you take a look at brokerages, had a field day yesterday, highest since 2018 for the financials index here in Hong Kong. For more on this, let's bring in Jason Lui, head of APAC equity and derivative strategy at BNP Paribas. There's so much about the southbound flows. What are fund flows telling you about where things going now?
Sure. It's certainly a very fascinating story when you look at the evolution of southbound flow just this year alone. If you rewind the clock back to the first 4 months of the year, we had this incredible runway that I think southbound investors were on average buying almost $20 billion per month in Hong Kong for the first 4 months. And then we saw this rather significant deceleration at one point, net selling into Hong Kong towards the end of April and then beginning of May. And then for the past month or so, we start to see them gradually coming back, but only have half the pace. So at the beginning of the program, you mentioned about Hong Kong kind of having a nice rebound. We are now trading at the highest level over the past few months. That also coincided with this kind of reacceleration of southbound flow. But when we dig a little bit deeper into what exactly are they buying, we also notice a few very interesting phenomenon. So we tend to think about the southbound flow with two key objectives: value and growth. On the value side, we believe that ever since this gradual decline of onshore interest rate, they are constantly looking for alternatives to provide them a little bit higher interest yield. And I think these high dividend yielding stocks in Hong Kong have been extremely appealing to them, and this remains their core component. What has evolved is their growth. We know that growth is hard to come by when the broader market is still under deflationary pressure. And so they were focusing on tech. And thanks to DeepSeek, you had this kind of almost explosive moment where investors all kind of get into the tech story. And then that kind of fizzles out a little bit.
Yeah.
And what we have seen so far is that over the past few months, they still maintain their value component, meaning that they're still buying these high dividend yielding stocks, but then they become a lot more selective when it comes to growth. You tend to see a lot more sector rotation. You tend to see a lot more kind of intra-sector rotation, which kind of brings down the overall net inflow. But as a whole, they're still quite active in Hong Kong.
So does that tell you that the rally's going to broaden out, or that the amount of buying is going to broaden out, or does it, to your point, remain a little bit more selective for now? And, and the fact that it's less than what it was to start the year, is that more sustainable, or is it just people are choosing to invest elsewhere?
Sure. I think to answer your question, we probably have to bring in two other elements. Your colleagues earlier mentioned about the Hong Kong dollar. I think you also mentioned earlier about the interest rate situation in Hong Kong. So if you continue to see a relatively low interest rate in the front end for Hong Kong dollar, that seems to suggest there's still a lot of liquidity looking for a home. And we have seen the IPO activities in Hong Kong remain very robust for the past few months. And I think one of the unique features of the Hong Kong equity market is that whenever you have very vibrant IPO activities, you tend to draw in more capital from elsewhere. So you can help sustain these kind of activity level. That's the first part. The other part is that when you look at overseas flow, because southbound is more mainland investor coming to Hong Kong.
Yes.
But when you look at overseas flow, we also notice a few very interesting things. So let's take US listed ETF, for example. We know that there are all kinds of ETF listed in the US, and one segment is international underlier ETF listed in the US. And if you look at June, and if you look at top 2 or top 3 emerging market ETF, we're actually seeing very robust fund flow. I think the top 3 of them probably receive around $3 billion or more in this month alone. And yet, it does not translate directly into China-focused ETF. So you've seen investors putting money into the overall emerging market, partly because of this kind of diversifying away from dollar perspective. But they are not quite fully convinced that I want to just be dedicated to China. So I think at some point, this overall allocation could translate into more China-specific allocation. And I would imagine that investors are looking for signals from the Politburo meeting in July and any other potential product innovation coming out from the Chinese tech space.
So is that still the next catalyst for onshore equities then? You know, right now they've kind of been lagging Hong Kong. Do you see some signs of catch-up there?
I think historically, if you compare the sensitivity of onshore versus offshore to domestic policy, it is true that the onshore market tends to be a little bit more sensitive to that. And so I think in the absence of any major policy shift, perhaps the onshore market will be this kind of holding pattern until we get a little bit more clarity on the policy side.
Okay, that's sort of the Hong Kong or Greater China market. What are you looking for in other regions? I know you've got some views, for instance, on Korea versus Taiwan and the post-election rally that we've seen in Korea, but what that actually means for Taiwan in turn.
Sure. So when we look at the rest of the region, one of our highest conviction trade this year has been long Korea, short Taiwan. And if you look at the performance since the Korean election, indeed, Korea has outperformed Taiwan by almost 10%. But what is interesting to us is that when it comes to foreign fund flow, you're not seeing the same magnitude of differential. In fact, as of yesterday, on a month-to-date basis, foreign investors actually bought more Taiwan than Korea, even though by just a slight margin. So that seems to suggest to us that the Korea rally has been a lot more domestic-driven, and the foreign investor hasn't quite fully just pure Korea. I think they're buying EM as a whole, to our earlier point about allocating into emerging market. I think the fact that you have this kind of resumption of AI optimism, especially in the US side, naturally feeds more into the Taiwan story than the Korea story. But over the medium term, we still believe that there are a few things that is probably in favor of the Korean market that can continue to close the valuation gap versus Taiwan.
There is so much going for equities here in Asia. I'm just wondering, you know, when you get to July, we're getting closer to a lot of these tariff deadlines or the truce deadlines, August for China. I mean, what are some of the risks that you're seeing for equities here in the region in the next few weeks or so?
It's definitely a great point when you bring up the tariff, because we've been quite focused on other geopolitical events rather than the tariff itself. At the moment, it seems that there's been fairly limited news flow in terms of incremental deals. So I think we would imagine that there needs to be a little bit more development on that side in order to encourage the U.S. administration to continue to think about other negotiation. But if we look across all the major markets, we are of the view that on the China side, they are well prepared to, at least for this year, to try to sustain an elevated tariff level. It is not clear to us other kind of Asian economies, are they fully ready to take on the full load of the reciprocal tariff?
Jason, thanks very much for your time this morning. That was Jason Lui there, head of APAC equity and derivative strategy at BNP Paribas. And we're counting down, of course, to the open of trade just around 8 minutes from now. But futures are looking a little bit weaker here, but notably going to be watching what happens with the Hong Kong market, of course, guiding for a 0.5 percentage point drop. But we have seen that intervention by the HKMA to defend the currency peg. So we'll have plenty more ahead. This is Bloomberg.
Your agenda here today, we're still watching Hong Kong dollar here, and of course we come off the weaker end of that trading ban after the central bank did buy the local currency on Thursday. So certainly we'll watch how close, what this means for HIBOR rates in particular. I think DBS was the one to say, look out for a 1-month HIBOR to actually come off now from the lows. You take a look at how the stocks rally. Certainly we talked about superlatives in Hong Kong, and China starting to a little bit in the onshore market come back to life here. That SUV launch for Xiaomi, that's coming up as well. We're continuing to watch what goes on in Tianjin and the WF meeting there, or WEF, I should say. And Li Choung, the premier, is going to be speaking at the AIIB right today in Beijing as well. Pre-market is looking like this. We're seeing a little bit of pressure across equities, but looks like we are heading to see some pressure there. But it is all about the FX side of things. So Hong Kong dollar, the dollar as well, the Bloomberg dollar index now at those 3-year lows and really leading the euro to go on interesting sort of inflection point there. So certainly that's going to be the big thing in the FX markets here today. These Fed rate cut bets continuing to be pushed earlier as well. So July looking more possibly a bet than September.
Yeah, and of course, playing into that story today is the reporting from the Wall Street Journal, because if President Trump is going to nominate his pick earlier, that does really start to build these bets of easing sooner rather than later. So July very much in play. But also taking a look at analyst actions in the session today. So again, the ones we're watching in particular, well, it's CATL that's got new overweights rather from JPMorgan, Jefferies, and BNP as well. But that is one to watch, of course. We've got the CATL interview. CMO, of course, joining us exclusively, I think.
Yeah, that was a great conversation with Stephen Ingles at Tianjin, and certainly we'll watch what goes on when it comes to CATL. This is what the shares are doing here right now. So extending a rally here as well. So the fact that they're prioritizing this overseas expansion certainly is how they're going to go with this EV price war. We'll get more from that interview coming up. This is Bloomberg.
Welcome back. You're watching the China Show this morning. We're counting down to the open of markets. Really, a lot of the action so far today has been in the FX space, because we've seen the de facto central bank here, that's the HKMA, of course, stepping in to prop up the local currency essentially, but intervening to defend the FX peg. So very much keeping a close track on what's happening with the Hong Kong dollar. Also broadly in financial markets this morning, or FX markets, it's also that dollar story that's really been, it's the major determinant as well of what happens with the peg, but still watching that very closely, given that dollar softness after we had the Wall Street Journal reporting around what President Trump may do in terms of the next Fed chair.
Yeah, if you have concerns about central bank independence and also where monetary policy goes, that is the way to express it here this morning. And that's why you are seeing the likes of the Hong Kong dollar and the HKMA intervening and really buying up the currency here to try to defend that peg. We're watching very closely the euro, as we talked about. And really, when it comes to equities, we're still kind of in this holding pattern right now here today. So CSI 300, we're slightly down. But, the Shanghai Composite is around that 3,500 level, which is quite a milestone there. And, we are topping the peak that we saw this year yesterday. So certainly that's one thing to watch, whether we see that sort of onshore market mojo come back here compared to what we saw in Hong Kong, where Jason Lui from BNP Paribas just told us a lot of the southbound flows is still very much a key story there. Onshore, we might have to wait for some news domestically first in terms of policy to really see this market to take flight once again. We're watching very closely. Shanghai crude is slightly lower here. We've talked about all those analyst upgrades when it comes to CATL. That's helping at least the A share just slightly here this morning. And we're watching very closely what happens in Hong Kong, right? So after what we saw with HKMA, we have also the tech space very much in focus, given what we heard from Xiaomi later on today. But Hang Seng Property, that's the one to watch. So we've seen about 4 sessions where this space has really kind of propped up here. And what we were focusing on now is what this means, right? Once we did see Hong Kong intervene, should we expect HIBOR rates to come up now? And what would that mean for the property space? Right now, the downside is for property. If, in fact, we see borrowing costs shoot up again, that is the concern there for that sort of space. But yes, in terms of what the Hong Kong market is doing, we're seeing more downsides here and modestly lower by 0.6% in Hang Seng. HS Tech also falling a similar measure. And there you go. Hong Kong dollar is doing this. So we come off the week end of the trading ban. Obviously, there's a lot of questions about how sustainable these moves are going to be and in whether HKMA is going to have to continue to defend the currency here in the coming months or so. And then what does it mean for the peg in the future? Certainly, we're going to be asking a lot of those sort of questions with the likes of OCBC's Francis Cheung coming through and later on in the show. Property, there you go. So you're seeing most of these Hong Kong property developers following here this morning on the back of this intervention from a Hong Kong dollar and what this means for HIBOR. So Henderson Land seems to be leading that loss down. We're about 3% lower. And we're watching these brokerages, right? It's been an amazing run for some of these brokerages. You take a look at the likes of Guotai Junan International. Whoa, we're up another 61%. This is after they surged more than 100% yesterday. That was the most on record. No surprise there. But this is after the brokerage received Hong Kong authorities' approval to offer trading services for virtual assets. So getting that license certainly is, the crypto trading approval is a big win for that brokerage in particular there as well.
Yeah, certainly an area that we're watching very closely. But let's broaden out the conversation and talk about really what you were mentioning earlier around how we've really seen Chinese stocks on a pretty decent run. I mean, a lot of different superlatives, but the HSI, the HSCI, their highest since March. The CSI 300 also hitting levels again that we haven't seen since March of this year. But let's get more on that and bring in our Asia equities reporter, Charlotte Yang, who's with us this morning. And Charlotte, what do you make, really, of the moves that we've seen recently, and where do we go from here, particularly as we were discussing earlier, that we've still got these trade negotiations? We haven't heard much about them, but the deadline is fast approaching.
Yeah, so I think the moves we're seeing for the broader China market is quite surprising, especially this week. At least for those, I think, for foreign investors, how do you get sentiment excited over a military parade, and then you have those surges in the defense sector. But with that said, I do think there are a lot of sector and also specific companies that might that are coming out with exciting and interesting stuff. I think one to watch is Xiaomi, with its EV launch later today, and also you do have the stable coins that looks like a global frenzy from the U.S. to Korea and now to China and to Hong Kong. Some of the smaller names, but there are many I think interesting themes.
Yeah, you mentioned about Xiaomi. Let's throw out the chart of what we're seeing, right? We're near a record for the stock ahead of this launch. What are some of the key things we need to be watching out for?
Yeah, I think the most important thing for the EV launch is the pricing, because initially we have evidence that says consumers have pretty positive reactions towards the specifications of the car and also for the looks of the car. But pricing is what determines how the demand will be, given how competitive Chinese market is. And analyst estimates are looking at the range of 250,000 yuan to 330,000 yuan. And that's also where Tesla's Model Y and also BYD's competitive model, the direct competition model, falls in the range. So if the pricing is below that range in estimates, I think that would be a big, very positive catalyst for the stock. And also, investors are also watching how the consumer orders will come in the first 24 hours as well as the first 7 days. Those are the cancelable orders, but for the first model, the SU7, they had, I think, almost 90,000 orders that came in 24 hours. Wow. So I think that's the benchmark.
When you look at the success of the Xiaomi story, it's really based around their business model, which is the 3 pillars. You've got your car, you've got your home ecosystem, and you have your phone. And you think about the sort of where they stand on each of those. Phone and IoT is strong, but we still don't know enough about the EV side because it's just such a new business. So how important is this success of this new model going to be for the stock moving forward?
I think it's so important. I think this is the single most important catalyst for the company because of so many, positive, exciting highlights. People forget that this is still an EV startup, and you don't actually get many chances if the second model fails. And also, especially Xiaomi is pursuing this strategy like Tesla, which you're trying to sell, just produce few models but sell a lot of it, each one. So the second model is very important. And also, they have this ambitious target that they're going to want the EV business to turn profitable in the second half, and you need the production skills. And also, the EV, and why investors are exciting about this company is not because of the smartphone business, because overall it's still slowing, right? So I think it's about having this China's Apple / Tesla in a way, and that connectivity. So you need the EV to show.
Yeah, we're not talking too much about Xiaomi phones or, toothbrushes and
no, it's really the focus on the car.
It really is all about this this new EV car there. All right, Charlotte Yang, thank you, our Asia equities reporter, joining us there on, of course, this Xiaomi launch happening a little bit later on today. Now, as we talk about China's EV market that gets increasingly crowded, the world's top battery maker, CATL, is looking overseas to supercharge its growth. We caught up with Chief Manufacturing Officer Ni Jun at the World Economic Forum in Tianjin to hear how they're powering their next phase of expansion.
Irrational competition, I will call. Everyone, the industry-wide and the government knew this is a problem, this is unhealthy, this will destroy the industry. So there's a lot of a sentiment to come up with regulations, a policy to prohibit this kind of price war. And as a result, that also forced everybody to dig in. Can you further improve your internal efficiency and so maintain reasonable business margin to survive, to continue innovate? So as for that part, I expect they will.
How are you doing that? How are you improving your efficiencies?
We are trying to do everything, improve the production utilization.
How is AI employed?
AI has been used. Actually, CATL has been embracing the AI revolution maybe 7-8 years ago. At that time, it already started from simple, repetitive task and manual work. They try to use AI to capture, to do more efficient work. And now we're not only using AI to screen the material, because of different material, different chemistry, and also different design. And also during the stage of manufacturing, and also after the sales. So AI has been utilized to improve, make sure the process is stable, is under control.
Over the next 5 to 10 years, what would your ideal next generation super battery factory look like?
Well, I would say in the next 5 years, ideally, let's take on all the trade barrier, all the consideration. Ideally, it should be green, number one, because we want to save our planet. The factory, we actually already do extensive improvement. We reduce our energy consumption, reduce any of the emission, and recirculate any of the waste material will be recirculated into our production. That is the number one. Number two, it should be smart so that any human labor-intensive, dangerous task should be taken care by machines, by robots, by computers. So that's what we are saying. Also should be reconfigurable, because when you put that production, this is a capital-intensive facility. Yeah. When you put that production line, you don't want to see, after a year, the product, the end product, our customers' vehicle don't sell well. They say, we would like to switch that to a different vehicle. Right. Can you quickly, flexibly adjust, adapt to the new product? So that's our effort. We try to make it as user-friendly as possible.
How do you avoid the pitfalls of overcapacity that has affected the solar industry right now? And a lot of people in the industry are fearing that maybe there's going to be a battery overcapacity in the coming years. How do you feel about that?
Well, we don't look at that. We believe when the global community going to green, sustainable world, and there's a surge, the demand is drastically increasing. The key is a high-quality battery. Of course, you can. If you don't put a high standard, you can put a cheap battery. That capacity maybe is plentiful, but the consumer And our basically world-class OEMs in car industry, in energy company, they demand a high-quality, safe, and a long-life battery. For that, there's a shortage. Otherwise, we will not go to many parts of the world to make those high-quality batteries.
Would you say going overseas now because of the high
demand?
That's well, right. There's obviously, I wouldn't say the market is saturated in China yet, but there's a price war, obviously, which is brutal. Would you say, though, that your number one priority is kind of figuring out the international expansion?
That's right.
The best, I guess, algorithm for making it work. Is that your number one priority?
Yes.
That was the CATL Chief Manufacturing Officer Ni Jun speaking exclusively with our Chief North Asia correspondent Stephen Engel over in Tianjin. Coming up, it's that focus really on what's happening today in the FX space, but we'll be speaking with OCBC Bank about Hong Kong's intervention to stabilise its currency and maintain the dollar peg. We'll have plenty more ahead. This is Bloomberg. Taking a look here at a two-day chart of the Hong Kong dollar versus the greenback, the big story for this pair this morning is really what the HKMA has done. That is the de facto bank here, or central bank rather, in Hong Kong. But they've stepped in once again to defend the peg. Now, the range that's permitted and has been permitted for several years now, decades, is 7.75 to 7.85 per dollar. But we touched the weekend of the range, and so the HKMA stepped in. The last time we saw intervention on this side was back in May of 2023. But let's get more on this now, bringing Francis Cheung, Head of FX and Rate Strategy at OCBC Bank. And Francis, maybe let's just take it back a step and look big picture. And what exactly has led to this dynamic in the first place?
Okay, if we remember, actually during early May, right, Hong Kong IPO did intervene, but to the other side when the peg actually hit the lower bound. So subsequently, a lot of liquidity has been injected into the Hong Kong dollar interbank market. And now that spot has since been going higher, and market actually has already been expecting this to happen for quite some time now, because spot dollar Hong Kong was trading very near the top side for most of this month. And in fact, actually over recent few days, spot did touch 7,800 without trigger any FX intervention before overnight, because I guess of this very negative Hong Kong dollar US dollar interest rate differentials, meaning Hong Kong dollar interest rates are very much below dollar interest rates. A lot of carry trades have been put on with likely some profit taking level just put at 784.99 level. So it has been taking quite a while for Hong Kong IPO to chip in. So now going back to the latest FX intervention, the amount was actually quite small at 9.4 billion level. Just now we mentioned about the earlier liquidity injection. So interbank liquidity in the Hong Kong dollar market is at around 170 billion. So in order to bring this 170 billion down to some meaningfully lower level, then we suspect that further or additional FX intervention will be needed.
Okay, so we might need to see more of the HKMA stepping in. What does that do to HIBOR rates, right? Are we likely to rise back to 1% or above and stay there, or sub 1%?
Okay, the relationship is actually not linear, as mentioned, because the interbank liquidity is still quite huge. Just to put things into perspective, before early May injection, the interbank liquidity, which we call as the aggregate balance, was at sub 50 billion level. So now, even after the overnight intervention, it would be at 160 plus, that kind of level. So still around 4 times the level before the pre-May intervention. So we suspect that any rebounds in HIBOR might not be as forceful as initially thought. That's it, but if the increases in Hong Kong dollar rates are not as much, that would only mean that Hong Kong dollar rates remain well below US dollar rates. So even if the FX intervention suggested that some earlier trade positions have been cleared, we cannot rule out that there would be new trades being put on, right, because of the carry. And then this process may just repeat itself. But the key takeaway, I guess, is that the whole process seems to be dragging out a bit, and it might take a while for HIBOR and front-end Hong Kong dollar rates to adjust or normalize back to a level which might still be likely below pre-May levels.
Our colleague Mark Cranfield did mention it, obviously we're seeing that spread between U.S. and Hong Kong rates, but what to really watch is Hong Kong rates converging with China rates, which is quite an anomaly. I'm just wondering, do you see that changing in any way anytime soon, Francis?
We actually don't see too much correlation between Hong Kong dollar rates and China rates. If we take a step back, actually, that would be fair to say that probably partly because of this overall grand scheme of diversification away from dollar assets, we actually have been seeing a lot of divergence between Asian interest rates and US dollar interest rates. So Sing rates, for example, is also very much below US dollar rates, and some other markets for a long time, the rates in Asia are also below US dollar interest rates. Despite the currency board system, there's nothing preventing these rates differentials to fluctuate across time. And we do feel that the Hong Kong dollar peg is still the best options at this point in time. That would lead to a lot of stability in the Hong Kong dollar market, which is very conducive to Hong Kong being or retaining the status of a financial center.
Yeah, I think you've just sort of answered my question there, but it is the perennial one here in Hong Kong. Does that Hong Kong dollar peg continue to make sense, and do you see it staying in place?
Yeah, we do think it makes sense, and as mentioned, it is still the best choice at this point in time because as a small open economy, of course, what Hong Kong would like to see is a stable kind of a currency environment. Then that would attract a lot of other investment or some like boost to the domestic economy. And as also mentioned, that because the peg doesn't really mean that Hong Kong dollar rates must follow US dollar rates in lockstep, although the direction usually is the same. So there is still some leeway for Hong Kong dollar rates to behave in its own manner. And if anything needed to like kind of counter-cyclical wise, there could be other macroprudential measures and also other fiscal measures to try to steer the economy onto the right path.
I would like to get your dollar view, Francis, as well, because we've already seen the Bloomberg dollar index drop more than 8% this year. We're already at 3-year lows. And there's a narrative that the Fed's going to have to cut sooner than later. And obviously, there's also news and chatter about maybe having a new Fed chair earlier. How much more downside are we likely to see in the dollar?
Okay, so our Fed view is slightly more dovish than the market. So we have been looking for up to 3 cuts this year. And that is the cyclical factors that might mean that the softness in the dollar can be sustained. And again, taking a step back, right? So we are talking about this structural issue about diversification away from the US dollar assets. And indeed, we have been seeing a lot of diversion flows, even in this part of the world, in Asia, Singapore, Malaysia, etc. So we suspect that this softness in the dollar might be a trend going forward, and that actually also feeds back onto the Hong Kong dollar mechanism that we mentioned just now, right? Because against the soft dollar background, then the spot TT, I mean like dollar honky, even if the market try to push it higher, it might not require a lot from Hong Kong MA to push the pair lower again.
A big component, of course, of the dollar index basket is the euro, and we're seeing a lot of strength coming into that currency as well. And we were talking earlier about what could be sort of the line in the sand for it to even go to 120, which is 117, and we're close to that right now. How are you watching that currency and the trading dynamics?
Okay, sure. So the ECB probably is already going towards the tail end of the monetary easing policy. Instead, the Fed, I guess, has a lot to play catch-up if they put more focus on the labor market and put aside some fears or concerns about inflationary pressure. So interest rate differentials should be going a bit more favorable for the euro. And as a second step is that speaking of some reserve currency status, the euro has yet to regain its status or shares, for example, in the reserve currency mix. So we do see potential for the euro to benefit from some potential diversion flows away from US dollar assets. And if you look at the euro area, there's a whole bunch of fixed income products that you can invest in of slightly different credits, but your funding cost is still in euro, which is relatively low.
Sure.
So that is actually quite conducive to inflows into that Eurozone area.
Francis Cheung, thank you so much, head of FX and rate strategy at OCBC Bank. We got plenty more ahead. This is Bloomberg.
Taking a look at markets here, and we're seeing a sort of divergent action. You've got 8 shares, for instance, the Hang Seng under pressure today, but we are seeing some strength more in the mainland, or at least flat. But let's also take a look at one of the big movers in the session today, and that is Guotai Junan International shares jumping as much as 102%. It is the most on record, but we'll have plenty more ahead. This is Bloomberg.
Welcome back to the China Show. Here's a look at the HSI a half hour into the session. And obviously, after we saw quite a decent rally, we are coming off a little bit of that here and snapping out of 4 days of gains. We're down about 0.6% for the HSI here right now. Onshore is doing a little bit better, but we're pretty much flat on those benchmarks here this morning. But a lot of talk in the FX markets here today, Belle.
Yeah, well, there's two different stories we're watching closely. Firstly, you've seen dollar weakness, and that's really after we had reporting from the Wall Street Journal that President Trump could bring forward the date at which he decides on his nomination for the next Fed chair, and that could be much sooner, really, than what we would see typically, because, of course, Jay Powell is still in this position for another 11 months, but it could be nominated around September, October, in a bid, really, to try and undermine Powell. Of course, that's the spin the Wall Street Journal has on it. But off the back of that, you are seeing dollar weakness and watching what's happening with the euro, because you're at levels here that we see close to 117. This is a really important line in the sand that could, even if we do break that, open us up to 120, which would take us back to 4-year highs for the euro currency. So again, tracking that very closely. And again, how it's being expressed in Hong Kong today, because watching, of course, the intervention from the HKMA, again, that's sort of to try and defend that currency peg that's in place. But let's take a look at what we're seeing across assets today, because you're seeing equities that are moving higher, yields that are retreating a little bit. Again, it's that story around the Fed, this expectation we get cuts sooner rather than later. And as well, what's happening with gold, little changed here today, but just some of the things we're watching closely.
And it's interesting, right? The Hong Kong dollar, as we talked to Francis Cheung from OCBC, we come off the weekend of the band, but then again, she's saying, look, the HKMAs might have to intervene more, and that more interventions are possible here, particularly because what you're seeing in the carry trade, right? So she mentioned that the latest intervention was actually quite small, and what you're seeing in the rebound in HIBOR, which we might get a little bit later on, might not be that big, just given because you have such a gap between where U.S. and Hong Kong rates are. That carry trade is still there. So there might be more of a means for the HKMA to step in, and we actually might still see the honky dollar get closer to that 7.85 area, part of the band.
Yeah, and as we've been saying as well, this is sort of the first time that we've seen intervention at both ends of the trading band just this year, going back to May 2005. But of course, again, it's that story around the dollar dynamic, and a Wall Street Journal report, as we've been saying, is that President Trump might name the Fed chair early. So he's expressed his frustrations, as we know, repeatedly with Jay Powell. But take a listen.
Yeah, I know within 3 or 4 people who are going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible. We have no inflation. We have a tremendous economy.
Let's bring on our MLife strategist, Mark Cranfield, joining us from Singapore. And Mark, of course, this is just, again, it's Wall Street Journal reporting, and it's a really big question is if we do get that pick early, what does it actually signal for Fed rate cuts? We know maybe there's that expectation we're going to see easing sooner rather than later, but there's also a lot of challenges from picking someone because you've still got to be able to influence the committee as well.
Well, yes, that is a good point that you raised there. But I think what investors are looking at here is that Donald Trump, as president, has made it pretty clear that he would like lower interest rates in the United States. And he's repeated that several times, saying that the current Federal Reserve have been too slow to lower rates. And he's also given his ideas on how far those interest rates should come down. So investors will be making the assumption, which is not too difficult to make, that whoever is chosen as the next Federal Reserve chairman will be coming in with a mandate to get interest rates down, and it will probably happen relatively quickly. Now, by bringing it forward as early as something like October, which is being suggested in this media report, you're essentially making Jerome Powell a lame duck chairman, and investors will have to look at whatever is being said by the incoming person and those who are likely to stay at the Federal Reserve, people that President Trump has already put in place. Mr. Waller is an obvious example, who recently has been calling for a rate cut as early as July. So at the moment, the market is not pricing for a full 25 basis points, but there's plenty of time for them to do that before that next FOMC meeting. We're already pricing for a cut in September. Moving that forward by one meeting is not such a big deal for financial markets. They move pretty quickly, as you can see with what's happening with the US dollar at the moment. So you have so much there out in the space there where people are consuming this information. They're making their decisions on a forward-looking basis, which suggests that US interest rates are going to come down sooner than later. They need to price that into bond markets, into currency markets. And it's almost as though they can ignore whatever's going on in there's a dispute going on in the Fed where some people think they should cut a bit later, some think they should go sooner, they should look at inflation. All of that may become immaterial if President Trump takes over the narrative and says, this person is coming in and I'm giving him the job to get rates down. That's all the market will care about.
Okay, we talked about the euro. I mean, what's the best way to express this view then? I mean, dollar weakness, how much more downside are we likely to see in the greenback?
Potentially quite a bit. As you were saying, Bloomberg has quite a detailed story about some of the levels to watch in the euro. 117 is the nearest one, and we've got there pretty quickly. There's a lot of options expiring there. If we push through there, might not be too much trouble to get towards the 120 area. It's pretty amazing when you think it was just in February that people were lining up to push euro below parity against the US dollar. People thought there was no chance for the euro currency. Things in Europe weren't going well. And then everything changed when Germany said it was prepared to spend more on defense and open up its fiscal coffers as well. Since then, the euro has completely rebounded, and now it's leading currencies against the US dollar. Just yesterday, we have massive volumes in the option market, with euro-dollar options 4 times as big in terms of turnover against dollar-yen. That's almost unprecedented, but it shows you just how many people are jumping on the euro. And it's very important because it's a two-sided equation. You have to have positives on the euro side and negatives on the US dollar side, and they're coming together right now. That's an unusual occurrence. When it does, it becomes like a steamroller for the foreign exchange market. People cannot ignore it. You have both sides of the equation working in favor of a stronger euro, and you have the European leaders saying, now is the time to back euro strength. It couldn't be an easier environment in terms of making a choice. Which currency do you think is going to be the best in the G10 pack? Everything is pointing to the euro, and traders can see that very clearly.
Yes, as you say, it's pretty stunning how quickly we've gone from parity or around that point to then looking at the prospects of 120. But let's also talk about what's happening with Hong Kong. Of course, there's a lot of talk this morning about the intervention that we saw from the HKMA to defend the peg. But we just actually spoke with OCBC Bank over in Singapore, and they were saying that there is scope for moves higher. That is limited, but as well, further intervention can't be ruled out. Do you see that prospect as well?
Well, the HKMA has to intervene as part of their mandate to do that. But they're also extremely experienced in defending the Hong Kong dollar, particularly when it's at the weekend of its band, as it is close to at the moment. I suspect they won't be rushing there. They get much more success when they allow the market to build up positions and get ahead of itself. If too many people, we saw this a couple of years ago when we had Carl Bass taking large positions against the Hong Kong dollar, thinking that he could break the Hong Kong dollar peg. The HKMA stood back, they let him build up his big positions until he was very exposed, and then they come in and they clear the decks and they support the Hong Kong dollar. And the effect is very dramatic and very fast, because not only does it wipe out the speculators, it gives a message to the rest of the market as well. I don't think the Hong Kong Monetary Authority will be rushing. They'll do their job, but they're very experienced. They know exactly where the weak links are in the market, and they will be watching that. And when the time is right, they will swoop in and turn the tide. But only when they're sure that they can win, and win decisively. That's the point about intervention. It's not just about showing your hand. It's about getting in the market and showing the market that you are the only person here. You're pushing it in a direction, and the market has to go with you. For that to happen, your timing has to be very good. And the HKMA have shown many times their timing is very good.
All right, Mark Crankfield, thank you. Your timing is always perfect. MLI strategist joining us there from Singapore. Still ahead on the China show, CATL tells us exclusively how they plan to prioritize overseas expansion as intense competition in China's domestic car market threatens the industry's health. Much more ahead. This is Bloomberg.
We're taking a look at what's happening with mainland and Hong Kong equities today, because we're about 40 minutes into the session so far and we're seeing a little bit of weakness, but we have to put it in perspective because it's been a very solid run and you've got a lot of these benchmarks at levels that we haven't seen going back to May of this year. But let's get a check now on what the outlook is looking like and bring in Marcella Chow. She's Global Market Strategist at JPMorgan Asset Management. So, again, it has been that pretty strong run-up. We heard as well from the Premier, Cheung, speaking yesterday at the WEF underway in Tianjin, and really emphasising that push for the private sector to lead innovation and be a key growth driver in the Chinese economy. But what stood out to you in the speech in particular?
Indeed, the emphasis on supporting privately owned enterprise, like POE, is actually in conjunction with what the symposium that was convened by President Xi back in February with private entrepreneurs, and also the first ever legislation that to support the privately owned enterprises in late April. And then recall that was like the first one to support private enterprises in promoting private enterprises in enhancing their confidence and also their expectations of private business owners. So that was key. And in the past months or so, we've seen, for example, with the antitrust and M&A regulations, that there have been easing regulatory pressure. So private sector sentiment has improved. So we do see value in that and remain quite constructive. But obviously, active management remains key because there's a broad list of privately owned enterprise in this universe. And then especially, we don't defeat how we see as not mutually exclusive. We still like, for example, SOEs because we like those with high-quality ones that focus on shareholder reform. But then the focus on POE is an encouraging move.
What are some of the metrics you look for then, if you have to really be quite selective in the POE space? Is it more towards the tech space?
The tech space, I think recently the sentiment was boosted by, for example, the AI technological breakthrough, and also the unprecedented, like the domestic animated movies, and also actually with the government's push to boost confidence. So along those and like the AI technology, those will continue to be key areas, and also push for innovation. Yeah.
Another big takeaway that we've seen from China recently, I mean, Lu Jiadui Forum I'm talking about here, is that push for the internationalization of the yuan. How exactly does that play out, and what sort of time frame are you looking at as well?
Yeah.
And we've seen the progress in the past few years, but then we continue to see the RMB being underrepresented. Just as a reference point, like in terms of international payments, trade finance, and also as a percentage of global reserve assets, US dollar account for around like 48% of international payments, but the RMB only accounts for like 6%. So 48 versus 6%. And then in terms of, for example, in terms of trade finance, US dollar accounts for like 83%, but the RMB only accounts for like 4%. So there is a big gap. And compared to, for example, China's contribution to like global exports was like 11%, or like global economy with a huge GDP of like 17% of global GDP. That is a big gap and big difference. So we continue to see RMB being underrepresented. But then with this Lujiazui Forum, with a focus on RMB internationalization, like you said, we believe that that can expand the use of RMB going forward with the new measures being introduced, and hopefully can advance the pace going forward.
They're taking advantage of a weaker dollar to kind of really shine the light on the renminbi. How do you view the dollar overall? I mean, it's just been really a down arrow story, except for that brief period during the war in Iran, where we saw the dollar actually catch a slight bid. Is it still towards a weaker dollar that we need to?
We do see, because of the policy clarity that we continue to need and lack of with the U.S. administration, and also the de-dollarization talk and rhetoric that has been ongoing, and also the whole U.S. exceptionalism waning. This will continue to suggest U.S. dollar to weaken in the medium to long term. And obviously, valuation remains quite expensive still, so there's still some way to go. But then, in the near term, we'll continue to monitor whether geopolitical tensions will lead to some technical rebound in the near term.
So it sounds like you're saying that the US exceptionalism story is still going to be sort of fading away a little bit. What are you looking at then as your primary markets?
Yes, especially because with this whole fiscal concerns and also the tariff, that like beginning of this week we were focused on the Middle East tension, and now we're going back to like the trade war and the trade tension, and going back to the fundamentals. And we do see like tariff concerns may actually lead to compressed in margins and also in a weaker earnings growth. And U.S. Equities might be more vulnerable in this backdrop given the still rich valuations. And then we continue to like broadening and diversification. Diversification is no longer like a hedge, but like a key source of return, because with diversification, you can actually diversify into, for example, Europe and also like China. These are of investors' interest lately because, for example, of government support into defense for Europe, and also, like we mentioned just now, with technological advancement in China. Those will continue to be key areas that we watch.
Marcella, Chow, thank you. Global market strategist at JPMorgan Asset Management. Coming up, we're going to head to the AIIB annual meeting in Beijing for an exclusive chat with the ADB on challenges when it comes to Asia's economic growth, and with the U.S. pulling out when it comes to aid in the region. What does it mean for the likes of ADB? This is Bloomberg. All right, amidst this dollar weakness, of course, we've been tracking what the euro is doing, but we're still watching that strength in the onshore renminbi. In fact, it has now strengthened to the highest since November against the dollar. So 716 levels there for the onshore rate. It's pretty much close to what the moves that we're seeing in the offshore markets yesterday, already hitting that sort of milestone when it comes to the offshore rate there.
Yeah, currency is really the big focus in the session for us today, but also watching what's happening, of course, with WF underway over in Tianjin, and a great interview here because we heard from the world's largest EV battery maker saying that overseas expansion is now its top priority. That's, of course, as it faces intense competition in China's domestic car market. Let's get more with our Chief North Asia correspondent, Stephen Engel, who's been speaking with CATL again on the sidelines from Tianjin. But Steve, really great interview, and what were the key takeaways for you?
Well, obviously, CATL had that big IPO in Hong Kong. They added more than $5 billion to their war chest. And we do know the domestic situation with, obviously, Xiaomi. We're waiting for the pricing of their new SUV. And pricing is the key because there's been a huge price battle, obviously, that is basically cascaded down throughout the supply chain, driving down prices and causing disruption in the domestic market. So that's why Ni Jun, who is the chief manufacturing officer of CATL, tells me that they're looking at their overseas markets, where they already have a factory in Germany. They're opening up soon in Hungary. They have a joint venture with Stellantis in Spain. They have a new one coming in Indonesia. This was just a sliver of a wide-ranging interview with the chief manufacturing officer of CATL.
Irrational competition, I will call. Everyone, the industry-wide and the government knew this is a problem, this is unhealthy, this will destroy the industry. So there's a lot of a sentiment to come up with regulations and policy to prohibit this kind of price war. And as a result, that also forced everybody to dig in. Can you further improve your internal efficiency and so maintain reasonable business margin to survive, to continue innovate? So as for that part, I expect they will.
How are you doing that? How are you improving your efficiencies?
We are trying to do everything, improve the production utilization.
How is AI employed?
AI has been used. Actually, CATL has been embracing the AI revolution maybe 7-8 years ago. At that time, it already started from simple, repetitive task and manual work. They try to use AI to capture, to do more efficient work. And now we're not only using AI to screen the material, because of different material, different chemistry, and also different design. And also during the stage of manufacturing, and also after the sales. So AI has been utilized to improve, make sure the process is stable, is under control.
Over the next 5 to 10 years, what would your ideal next generation super battery factory look like?
Well, I would say in the next 5 years, ideally, let's take on all the trade barrier, all the consideration. Ideally, it should be green, number one, because we want to save our planet. The factory, we actually already do extensive improvement. We reduce our energy consumption, reduce any of the emission, and circulate any of the waste material will be recirculated into our production. That is the number one. Number two, it should be smart, so that any human labor-intensive, dangerous task should be taken care by machines, by robots, by computers. So that's what we are saying. Also should be reconfigurable, because when you put that production, this is a capital-intensive facility. Yeah. When you put that production line, you don't want to see, after a year, the product, the end product, our customers' vehicle don't sell well. They say, we would like to switch that to a different vehicle. Right. Can you quickly, flexibly adjust, adapt to the new product? So that's our effort. We try to make it as user-friendly as possible.
How do you avoid the pitfalls of overcapacity that has affected the solar industry right now? And a lot of people in the industry are fearing that maybe there's going to be a battery overcapacity in the coming years. How do you feel about that?
Well, we don't look at that. We believe when the global community going to green, sustainable world, and there's a surge, the demand is drastically increasing. The key is a high-quality battery. Of course, you can. If you don't put a high standard, you can put a cheap battery. That capacity maybe is plentiful, but the consumer and our basically world-class OEMs in car industry, in energy company, they demand a high-quality, safe, and a long-life battery. For that, there's a shortage. Otherwise, we will not go to many parts of the world to make those high-quality batteries.
Would you say going overseas now, because of the high
Demand.
Demand. Well, there's obviously, I wouldn't say the market is saturated in China yet, but there's a price war, obviously, which is brutal. Would you say, though, that your number one priority is kind of figuring out the international expansion?
That's right.
The best, I guess, algorithm for making it work. Is that your number one priority?
Yes.
And that was CATL's Chief Manufacturing Officer, Ni Jun, speaking with Steve at the WEF. This is Bloomberg. $11:29 a.m. in Tokyo. Japanese markets are heading to that lunch break in just a moment. And you take a look at what we're seeing as strength, really, when it comes to the yen and weakness in the dollar. That seems to be the key theme across these markets here on the back of what we're hearing, right? The Journal reporting that President Trump is looking for a new Fed chair a little bit early. So the bets are now maybe we hear something later on this year, maybe September, October, according to that reporting. So certainly that is leading more to those Fed cut bets to be pushed forward, maybe more towards July, not a full rate cut priced in just yet, but maybe more towards July versus September. There you go. That's in the face of all that, though, equities are doing quite well in Tokyo. We're getting close to that 39,400 level for the Nikkei, Bell.
Yeah, well, it really sets up those conditions that equities in Asia tend to like, which is a softer dollar, lower yields. It's supportive of stocks. And so you're seeing that being reflected really across broader Asian equities today, up 0.3%. You've got IT very much in the lead there. But again, it was that story around Nvidia overnight because we saw a fresh record high for the company. It's now back into being the world's biggest as well. But seeing very strong outlook or demand really from customers still for its AI products. So that's really it there. But we can also take a look at what else is happening because there's so many events underway right now as well.
Yeah, and let's get back to Beijing in our coverage of the AIIB annual meeting. The event brings stakeholders and experts together to talk about infrastructure, financing plans, and developments. Joining us exclusively now is the Vice President of the Asian Development Bank, Scott Morris. Scott, it's a pleasure to have you on the program. And certainly in the face of all this uncertainty around trade, geopolitics, and the like, AIIB's Jing Lijun did talk about the need to reach out globally. How are you looking at things right now, especially at a time when the U.S. seems to be pulling out or threatening to pull out aid to this part of the region?
It's good to be with you. So, look, I think, for our agenda, for the agenda of institutions like AIIB, there's a lot of ambition, a lot of energy. So it continues to be an exciting time, but we do recognize that we're operating in a challenging environment for our countries across Asia and the Pacific. The geopolitical environment is challenging, but I think the outlook for the economies, while we've seen strong economic performance, there are risks, and I think we've been talking a lot to our counterparts in governments about risks associated with the tariff uncertainties. Certainly events in the Middle East, and we're watching closely what happens with oil prices because that represents a substantial potential shock for these countries. So again, operating with a lot of ambition, particularly around infrastructure investment, but also recognizing some of the headwinds these countries are facing in their economies.
And some of the headwinds are internal as well, or domestic, because to Yvonne's point, we have seen the US pulling back on external development financing, and I'm wondering, the decline of US aid, has that impacted the work that you're doing as well?
Yes, we are seeing some effects there. I think institutions like USAID have played an important role globally, so that withdrawal is a meaningful one. We are seeing opportunity ourselves as an institution, in some instances, to step in to find new partnerships, and I think they're looking for other actors who are willing to step up. This particularly plays a role in the social sectors, whether it's in key health investments, education, those kinds of sectors where we are in fact active, although it doesn't represent the biggest share of what we do. It's also important to recognize, as a development bank, we are primarily a lender. So we are not always well placed to step into a role that, previously was filled by the kind of grant assistance that an aid agency plays. So it does represent a challenge, I think, for a number of these countries, particularly the poorer of the countries where traditional aid, continues to play an important role.
And the ADB has also been collaborating with the likes of AIB in some key projects as well. Can you tell us how the dynamics have shifted? How has financing shifted at all, in your view?
Well, number one, the partnership between our institutions is a vital one. AIB represents our largest source of co-financing in our projects across Asia and the Pacific. It's been a growing relationship, and demand is growing. I think this agenda, and when we say infrastructure, that's very broadly defined. It's not just physical infrastructure, it is growing demand to support countries in implementing a digital agenda. It's even on the human capital side and investments that we can make to support the growth in human capital in these countries. So again, that demand is growing. Countries see the value in borrowing from our institutions and actively participating. I think the multilateral character of both of our institutions is core to who we are. So even in the face of what may be challenges bilaterally between countries, it is meaningful that among our leading members are countries like the United States and Japan, but also China. All of those things represent strengths, even in the face of these uncertainties right now.
One of the notable shifts we've seen recently, and this is talking about the World Bank here, but changing their stance on funding nuclear projects, and we've seen announcements that they're planning to be partnering with the IAEA to look at extending plant life in emerging markets, helping to build safer, secure nuclear programs as well. But are you looking at making any shifts as well?
This is an important area. We are, in fact, having active conversations with our shareholders. It was very notable to us to see that step that the World Bank has taken. I would say, as we have these discussions, our orientation is to recognize as countries both pursue energy transition, recognizing the challenge of fossil fuels, but also, primarily looking to achieve energy security. That is, build out energy systems that provide reliable and affordable options to growing, developing economies. We want to be able to step up and help them with the full array of potential energy choices. So I think that's what's motivating this conversation, and obviously some technological progress when it comes to nuclear is certainly appealing. So we have prioritized these discussions with our shareholders. We'll see where it takes us in the months ahead. But again, it is notable to see that step forward at the World Bank.
How far along are those conversations, Scott? I'm just wondering, how soon could you make a decision, given there are so much need for power consumption now, given the rise in AI around the world?
Well, look, I think it's important to recognize, number one, even under our current energy policy, we do have the ability to engage with countries on upstream discussions in which nuclear can play a role. Namely, how do we work with our partner governments in helping them evaluate energy choices? How do we help them build their own capacity to consider nuclear along with other options, going forward, recognizing that these are really very long-term investment choices. So yes, we will continue to have the discussions internally and with our shareholders on additional changes we might make in our policy, but it's not limiting in key areas that we can partner with our client governments right now.
Yeah, it's really just about trying to meet these ever-growing energy needs. But that was the ADB Vice President there, Scott Morris. Thanks so much for taking the time to join us from Beijing and staying at least with China, but certainly a big segue. We are talking about President Trump's tariffs. They're putting unprecedented levels of stress on Chinese manufacturers. Bloomberg visited one toy factory in Shenzhen to find out how it's dealing with the on-again, off-again trade war. Our China correspondent Min Lo reports.
The Barbie blow dryers and vanity kits, as well as these game sets, are just some of the toys made at this factory and shipped to the United States and around the world. Manufacturers are rushing to ship the goods as quickly as possible to avoid President Trump's tariffs on China.
The tariff impact on our industry is big, especially for companies like ours, where the majority of clients are based in the U.S.
Thousands of factories in China have been caught up in the trade war. America's largest toy maker, Mattel, has warned tariffs on China could lead to higher prices for consumers, with President Trump threatening the company directly.
They said, well, we're going to go counter. We're going to try going someplace else. That's okay. Let him go, and we'll put 100% tariff on his toys, and he won't sell one toy in the United States, and that's their biggest market.
Illinois-based toy company Learning Resources relies heavily on Chinese manufacturing. It has filed a lawsuit against President Trump, alleging he exceeded his presidential authority. Some toy factories like Bill's are looking to move new facilities to Southeast Asia to bypass the tariffs.
We are exploring overseas opportunities. For example, we are establishing a new manufacturing base in Vietnam, which is expected to begin operations in July.
Bill says for now, his employees in Shenzhen are working overtime, taking advantage of the current US-China truce. But if Beijing and Washington can't strike a longer-lasting deal, there will be plenty of tears to go around. Min Lo, Bloomberg News.
And subscribers can watch us live and see our past interviews on our interactive TV function, TV Go. You can also dive into any insecurities or other functions that we talk about, that story that Min just brought to you, and become part of the conversation by sending us instant messages. Check it out at TV Go. Well, billionaire Richard Li's FWD Group is looking to raise $442 million in an IPO here in Hong Kong, finally moving ahead with the share sale first planned 4 years ago. For more analysis on how this what it means, let's bring in Bloomberg Intelligence senior industry analyst Stephen Lam. Stephen, you've been tracking all this for years now. Obviously, there's been a lot of twists and turns. Originally, this was an IPO that was planned in the U.S., but FWD really got caught in this U.S.-China trade tensions and the like. How do you see this IPO playing out here in Hong Kong?
Yeah, hi, Yvonne. Yeah, like you said, we've been talking about this for a while. I think, at least they're getting it done. Although it is not as large as they had wanted to in the very beginning. I think they were talking about more than $1 billion a couple of years back. But, look, definitely the investment environment is a little bit more conducive for Hong Kong stocks, for example. And in terms of the valuation, I think what they're doing this time is quite okay in the sense that, they're not shooting for a very, very high valuation. So based on our estimates, you can think of it as sort of getting a slightly better deal than their larger peer like AIA, for example. But it's still at a respectable valuation of close to one's time price to embedded value. So, our take is that for this company, it is actually quite a good mix between developed markets and emerging markets. So roughly 60-40, if you think of it that way. The Hong Kong is definitely the golden nuggets of the group, along with some Japan and Thailand.
So how do you think they're likely to use the proceeds that are raised from this then? What kind of use cases would they be looking at?
Yeah, look, I think what they want to do, even though they're already the second biggest in Thailand, for example, but there's still a lot of room for them to grow, within the Hong Kong market. Obviously, they are within the top 10, but, there could be aspiration that they can move even higher, probably within the top 5. Now, that is not an easy thing to do, given the top 5 is very large, like the AIA, the Prudential, the HSBC of the world. But some of the peers like Manulife and Sun Life have actually been ramping up very rapidly in the Hong Kong market. So, the money would probably be deployed in really strengthening their distribution networks. So the bread and butter is still agency and bancassurance. So these things cost quite a lot of money, especially for bancassurance deals, if they can secure more. The other one that they can look into is definitely in terms of technology spending, how to improve the experience of the customers and use AI to assist, all the way from acquiring customers, acquiring policyholders, to servicing them, to claims handling, so on and so forth. Yeah.
That was our Bloomberg Intelligence Senior Industry Analyst, Stephen Lam there. Thanks very much for joining us. And just shifting actually our attention to some lines that just dropped. This is reporting again from the Wall Street Journal today, but it does relate to the competition that we see very intense in Silicon Valley, because last month we actually had Sam Altman going on a podcast, even actually a couple of weeks back, but going on his podcast to talk about how much poaching, or the risk of poaching, that OpenAI faces. And he was talking about people that he was aware of at OpenAI that had been offered sign-on bonuses of up to $100 million from Meta to move across. Well, maybe some people are taking them up on the offer, because there's actually that reporting today, again, from the Wall Street Journal, that 3 OpenAI researchers have now shifted can to Meta.
Yeah, I mean, there's a lot of competition. Obviously, Meta is throwing a lot of money into still AI, as you mentioned, and really, and I think Zuckerberg himself is really putting himself in these recruitment efforts as well. So really, it just shows how fierce things are. But I love how Sam Altman's line is like, "Oh, they didn't poach the best ones."
Yeah, that's what I did wonder. Some people have moved. We don't know if they're in the highest esteem of Sam Altman, but still some personnel changes.
Yeah, very interesting. Let's stick with AI, though, and talk a little bit more about Chinese spatial design software maker Manycore Tech. Now, they say that its business model is not affected when it comes to U.S. restrictions on chip exports. The co-founder and chairman, Victor Huang, spoke with Bloomberg about how he's managing the global growth of the firm that is part of a group referred to as China's Six Little Dragons.
Right now, we focus on the country like Korea, Japan, America, Southeast Asia. That is what we more focus on. And our strategy is we do PLG, product leads growth. Then we can see in which country the retention rate is higher. Then we will put more efforts on the high retention rate country.
Do you have some visibility right now?
Yeah, of course. We do pretty good in Korea, Thailand, America, and also India.
Right. India's a huge market. When it comes to the U.S., given the geopolitical challenges, are you feeling any of that strain?
I think for PLG, it's okay. For PLG, it's more consumer-based product. So just currently, everything going well. I didn't have any trouble from the government.
Because we're always very concerned about these export restrictions and perhaps more tightening coming from Washington. Is that at all a concern for you?
I think it's not a big concern because we are not going to compete with the large language model. It's a huge amount of high-end GPU. Our advantage is we accumulate a huge amount of just physically correct data that is so unique. So we can train our model slowly. So in that way, we don't need the biggest computing cluster.
When it comes to the future of your company, you mentioned different segments that are doing well domestically and also in the United States and globally. What is the overall ratio that you would think would be domestic versus other countries?
For long term, we hope 50% is from domestic and 50% from globally. But right now, the global income is about 10% of our revenue. We hope it will be growing faster. But actually, the online users, the PLG revenues is growing faster, much faster than domestic.
Oh, really?
Yeah.
Especially in America or in other?
Globally.
Like South Korea, you mentioned that
South
was
Korea,
good.
Yeah.
That was the Manycore Tech co-founder and chairman Victor Huang speaking with our co-anchor Sherry Ahn from the WEF in Tianjin. And actually, I think it's really important, as we said there in the intro, but this is a company that is one of the 6 little dragons from Hangzhou, and it's a name that has really changed as well the business dynamics, because I actually spoke to Victor as well earlier this year, and he was saying how previously nobody had really heard of this business. It's a really important business when it comes to the software that's needed for training humanoid robots. But of course, humanoid robots have also really just started coming into their own, say, over the last year. And so he was talking about sort of the recruitment and how much it's changed for him, because he said now they're at a point when they're getting applications from Harvard or Stanford, the leading universities in China as well. And there are so many of those. It's a really great interview.
And as you mentioned, right, it's not just about DeepSeek. We talk about DeepSeek all the time. There's so many emerging sort of startups that we don't really highlight enough, really, and really that is spurring the innovation. But what was the thing that the officials said just this week
More
about
than 100 DeepSeeks?
Yeah, in the next 18 months or so, right? I'm sure you'll be talking a lot about this because you got a new show coming up to talk about all things AI and the rest with Sherry.
Yeah, we're really, really excited about this. So it's launching tomorrow. There you can see me and Sherry there, but it's going to be a new program. So, of course, we already have the Bloomberg brand, or Bloomberg Tech brand, very established with the show that's led by Ed Ludlow and also Caroline Hyde over in the US. But we had Bloomberg Tech Europe that launched last week with Tom McKenzie. And now tomorrow we're going to be kicking off Bloomberg Tech Asia. And so premiering tomorrow morning, 8:30 a.m. So please do tune in. But as you said, it's really that focus on profiling the most exciting innovation that comes from this region. Plenty more ahead. This is Bloomberg.
So now going back to the latest FX intervention, the amount was actually quite small at 9.4 billion level. Just now we mentioned about the earlier liquidity injection. So interbank liquidity in the Hong Kong dollar market is at around 170 billion. So in order to bring this 170 billion down to some meaningfully lower level, then we suspect that further or additional FX intervention will be needed.
That was OCBC's bank's head of FX and rate strategy, Francis Cheung. They're speaking about the intervention from the HKMA. So HIBOR is certainly the next thing to watch here as it opens up the next hour. Now that we see that mid-board intervention, we're off some of the weekend of the ban for the Hong Kong dollar. Does that mean HIBOR rates can shoot up? Francis says not quite, because the carry trade is still there.
Yeah, and also, of course, this has a really big bearing for property and the property sector in Hong Kong as well. You can see these stocks that are under pressure today. And also a bit of a mixed picture for the brokerages. They've had a pretty strong run. It's been a lot of southbound flows, but taking a look at one that's really standing out, Guotai Junan, they've got their crypto trading approval in the city. More ahead. This is Bloomberg.